after the worst year in 2018 since 2008, in 2019, at least for the last few days, markets seem to be trying to recover. Is this really a recovery? Or is this an opportunity to get out before the real carnage begins? Indicators suggest there is a hard landing ahead. And the big question is, are the credit airbags ready? We're going to take a look at this today, coming up. I'm Lynette Zang, and welcome to ITM Trading. Now, you may have noticed what's been going on in the markets, but there's a canary in the coal mine regarding debt that we're going to talk about today, because this has really been brewing since the early 70s when we went on to a pure debt-based system. And we certainly know that credit cards are maxed out in households, and the government keeps taking on more debt. But today we're going to focus on the corporations. Because frankly, as long as you have income that can cover additional debt and debt payments, well, then at least it can look like you're okay. But we're actually heading into an earnings decline. Certainly in 2018, corporations benefited from the tax laws. But by the fourth quarter, that started to go away. And now we're in 2019, and essentially the impact of that, while we still feel it in our deficit space, it's declined. It's gone, essentially now. So we have some problems because from 2008 forward, corporations are now more leveraged, meaning that they've taken on so much more debt to the equity that they hold, much more than they were even during the crisis in 2008 and the height of the crisis in 2009. That's not a good thing. Now, as they've taken on this leverage, all of the studies from the IMF, the BIS, all these guys have shown that their cash positions have declined. Well, for you or I, if we're going along and we hit a problem, a fiscal challenge, if we have savings, okay, we can smooth that over. If we don't have savings, then we're really in trouble. It's not really the corporations that are in trouble. It's actually the rest of the marketplace. And I'm going to show you that in the next few slides. Because quite frankly, starting this year, in just this one little area, corporations are hitting a $4 trillion debt wall that must be either repaid or rolled over. Well, with cash declining, repayment is somewhat of a problem, and with interest rates going up, okay, refinancing, I'm going to show you this. And keep in mind that after 2021, then all of that debt must be restructured. So we've got a lot of issues that we are dealing with here. But I want to focus on one narrow little area of the market, which are the leveraged loans. Now, a lot of central bankers and bankers have been warning about leveraged loans because essentially they're taken out by corporations that can't really access easily or reasonably the regular debt markets. So already you've got the riskiest borrowers. On top of that, they essentially use up all of their equity. So we've got leveraged loans that are now higher than they were prior to the crisis in 2008. And this was just from 2017 or the end of 2018 or 17, I'm sorry. Going into 2018, they're already much higher. And as people have reached for yields in the zero rate environment, they've accepted less and less protection. So all of these leverage loans that have been issued have been covenant light, right? That transfers the risk from the issuer. We're talking about contracts, the counterparty to the contracts. That transfers the risk from the issuer to the investor. But now major investors, so these would be some of your pension plans that are still buying stocks, but pension plans and mutual funds that are not wanting to fund these leverage loans, and in fact have turned around to sell. And what does that do? That forces the banks that have issued these loans to hold a lot of this garbage on their balance sheets. And I don't really care that it's going to hurt their returns. I'm more concerned about the bail-in when these loans go bad and the credit markets freeze, just like they did in 2008. We can see that the price has been going down on them as investors have fled. But something I want to point out to you, because a lot of these are held in mutual funds, and in particular, Lord Abbott was approved for inter-fund lending back in 2016. You might recall that that means that they have the right to borrow from other Lord Abbott funds. So you may have their government money market fund, let's say, and maybe that's considered the safest fund that they have. But that also means that their riskiest funds, if they get tight on cash, they can go in and they can borrow from their other funds. So can you see all of this contagion? It doesn't really matter that it's in the corporate sector, because it is integrated into the banking sector, which hurts you for bail-ins as well as mutual funds, and the contagion around inter-fund lending. And they're not the only ones. That's just the example that I wanted to use. So the intention at the moment, and we've talked about this with the ETFs and all of the shares, stock shares of the ETFs and Apple, we're going to talk more about that. But when you have them concentrated, what's really happening is the banks are being forced to keep these on their books with the hopes that they can push the markets up and unload them to investors. Okay. You know, and then it doesn't matter when they go down. This is all about risk transfer. What I also want to point out to you is the CLO, collateralized loan obligation, is really a tool of arbitration that holds these leveraged loans and leverages them again, normally about 10 to 11 times. So you already have a product that is maximum leverage. In addition to that, you have another derivative product that is leveraged even more. And remember, a derivative is a bet, and it doesn't really have to have any relationship to the underlying. So even though we've been seeing stress in those leveraged loan bonds themselves, or those leveraged loans themselves rather, the CLOs, which are the vehicles that pension plans typically use to buy this crap, well, they hadn't been going down until recently. Now, I think it's really interesting that in particular, but this is true for many, large investors, so the Canadian pension plan is investing in CLOs. Now, this was at the height of the market, 926.18. So the markets hadn't, this particular market hadn't even quite hit its high yet, though it did shortly after that. Okay, well, now they're getting hit. But where the Canadian pension plan, the Canadian government is putting money that's supposed to be for retirees into this very risky paper, they halted your ability, an individual's ability to ship gold through the mail. So not only is the Bank of Canada not holding any gold in their reserves, and a lot of people think Canada is a lot safer. I don't really think so at all. But not only have they gotten rid of all of their gold reserves, but individuals can now not ship it through the mail in Canada. That's their answer. They'll put everything in risk, but they don't want you to protect yourself. Isn't that pretty typical? Because that's all about wealth transfer. If you could protect yourself, well, then, you know, then they lose that opportunity. But there are a lot of indications about the loss of credit in these markets. And that's not a good thing. It's like a canary in the coal mine. So for one thing, those new loan investors, they're headed for the exits. Look at this. You haven't seen any exodus like that going back as far. I mean, well, this goes back to February, but we haven't seen anything like this yet. This is a huge indication because investor funding is drying up. Also, since all of these companies have to refinance, their cash flow is not enough. And by the way, it's the cash flow that they use to collateralize these loans. So with the income going down, the access to the debt markets is also drying up. So it's not just maturity on the bonds, which are, most of them are coming due within the next few years and they have to be rolled over, plus what happens in 2021. But it's the constraining cash flow. So that global, which I'm going to show you in a second, that global slowdown that we're now hearing so much about, that we have been talking about for a long time, that makes it all that much harder for these corporations to service this debt. And in fact, for the first time since 2008, no junk bonds were issued in the month of December. There wasn't funding for it. Now, if you think back to 2008, we saw credit freeze within 24 hours. Those were CDOs. These are CLOs. 24 hours, done. You aren't going to know the second before that happens. Nobody is. So this is the canary in the coal mine. So when those credit markets fully freeze, because they're already freezing at the fringes, this is significant. They're already freezing at the fringes. Where will this funding come from? It's not going to be coming from increased earnings when all of the forward-looking indicators indicate that the global economy is slowing down. And it doesn't matter whether you're looking in Europe or you're looking, we haven't even talked about the Bexit, but certainly there in Great Britain it's slowing down, in Japan, and in China, and in the US, everywhere. This is not good. That's going to impact the earnings even more of these corporations and their abilities to hold on to that debt. And now, we've been talking and hearing about central banks. The ECB, Mario Draghi came out and talked about stagflation. We had Fed Chair Powell come out and talk about stagflation, even if they don't use that word. Increased inflation as depreciation in assets, stagflation. Now you've got Larry Summers, who anybody that's listened to me knows he is not my favorite person, but he's coming out and saying, prepare for a recession. But this is going to be way bigger than just a recession, because this is about that debt wall. And there's no coming out of that. They are ready for this crisis to happen. Because what are the tools that they have left? And what about all of the chaos that's surrounding all of these markets? I mean, we have still globally escalating trade wars. And while you may hear a little talk about this or that, I mean, frankly, the U.S. just recently increased caution to travel to China because China steals intellectual properties and can hold you in all of these things. Follow the links below and you can read the document itself. We also have no idea. We're now in the second longest government shutdown in history in the U.S. The second longest government shutdown in history. How long is that going to last? They're going to tell you, it's not really going to have any impact. but you've got about 800,000 people that are furloughed. Well, are they all going to get all of that back wages? We've discovered, since we've done these so many times, that always costs government shutdown. We don't know when that's going to end. And look at the government deficits. So at a time when the U.S. government anticipates over $1 trillion more in deficits, because this graph is only through 2018, they only publish that once a year. So how can they help the corporations? Though tomorrow we're going to talk about the doom loops that are being created by this event. So this is really critical. You have central banks with bloated balance sheets that already have a lot of the debt and derivatives and garbage on them that you and I as taxpayers are responsible for. And they're anchored still near zero. And look at what's happening to the markets as the Fed pal tries to raise rates. They're having temper tantrums. They can't do it. This is the experiment they're trying to unwind, and it cannot and will not and is not happening. So everybody is different. I know for me, I want to be as prepared as I can because I don't know exactly when we're going to lose choice. But let me tell you, this is unfolding right before your eyes. We are living through history. Can you see this? Can you see that we are between a rock and a hard place? Because even in China, even though lending and credit availability is abundant, all of that borrowing is no longer stimulative. Because when you get interest that's so high that it's consuming your income, that, my darlings, is there's two kinds of debt. Keep this in mind. There's self-liquidating debt and there's non-self-liquidating debt. So all of this debt that the corporations have taken on and paid out to either buy back stocks or dividends or leveraged buyout, which means there's virtually no equity in that deal. This is all non-self-liquidating debt. And it is all based upon the corporation's ability to grow earnings. And we have already entered the period where earnings are declining at a massive and rapid rate. I mean, they were only artificially up anyway. So consider this the canary in the coal mine. We got to watch this really, really closely. I've always said this. I'm going to say it again. It will be, the derivatives will be the death of the market. It's what's going to push us over. And most likely it will be these CLOs. So we're going to look more about the doom loops tomorrow. And also this week I did a great interview with Dustin Nemos too. And so that we'll let you know when that's posted. And next week I'll be talking to Sean at SGT. So please be safe out there. Keep in mind that shields are made of metal, not paper or promises. And until tomorrow, please be safe. Bye-bye.